Hello ladies and gentlemen, and welcome to another video from Swaraj Finance. Today is going to be an important video, I think, for all of those that are interested in the commodities markets. We continue to experience volatility to the downside, so sometimes it's important to revisit the thesis of commodities investments and the idea that we're in a commodities bull market, and look from a longer term picture, look at the big picture to see what's going on. So we're going to do that. Remember, the disclaimer is that nothing you see in this video should be taken as investment advice or as a recommendation to make an investment decision. You must do your own due diligence or consult with a financial advisor. So with that said, let's start with oil, which is really the master commodity. And I've pulled up a log chart of the oil price for as long as the data goes back. So this is around a century worth of data here, 100 years of data, and what we see is there's a pattern where you have stable oil prices, for example in the 40s, 50s and early 60s. Oil had been stable around the $3 level, and then in the early 70s what happened is the US was in the Vietnam War, became heavily indebted, couldn't meet the obligations. This was a time when gold was linked to the dollar, so the dollar was backed by gold. It was a gold standard. And because the US couldn't meet its obligations, it couldn't fulfill its promise to convert dollars to gold when France tried to do that, the gold became delinked, so the gold standard was ended and the dollar was devalued, so all commodities started to go up in price, and so that was led by gold, and then of course oil and all the other commodities responded in a similar way. So you have this huge spike, and this was through the 70s, and then by 1980 a new high had been formed, and then we had a couple of decades of consolidation. So from $3 oil went up to almost $40, so more than 10 times its price from a decade earlier. And from $40 it consolidated until around the year 2000. So between 1980 and 2000 you had a trading range in which oil formed a new base, a new price range, where the low was around $10 and the high was around 40. So between $10 and $40 a barrel for oil over those 2 decades. And then we had a start of a new commodities bull market, driven by various things: continued inflation, a housing bubble, so more dollars were being created through the creation of mortgages, which is how inflation happens. Money is created, is lent into existence. So when you buy a house, you take a mortgage, and that money doesn't actually exist. You're borrowing money out of thin air. The bank issues new money so that you can buy the house, and then you pay it slowly over time. So this growth in credit during the housing bubble of the early 2000s led a new commodity bull market, along with the growth in China and various other things also. So oil found a new high from $40, between 10 and 40 it then went up, so then hit a new high of over almost $150 actually, and that was in 2008. And from 2008 till 2023, where we are now, we've had this sideways consolidation where oil is largely traded between what was the previous high around 40. So 40 has been kind of a new low for oil over the last 15 years, and the high between $40 and $150 been the new range. And the thesis is that we're now breaking out on the way to set a new high, and this could be, if we look at this rising parallel channel, the trend lines, we could expect oil to even hit as high as $300, $400 if this channel is anything to go by. That seems quite crazy at the moment, but it's hard to anticipate these commodities markets. This is just a projected trend based on previous movements. So, but the pattern is very interesting. So if we look at the periods of consolidation, you have these trend lines which form, and then you break out of the trend, you come back, you retest the trend as we did in 2001 before going up. But so a commodities bull market doesn't mean that oil goes up in a straight line. So it breaks out, retests the trend line, finds support. What was resistance is now support, and then we move on upwards. And so we've had a similar thing. We've broken out in 2021, and we had this spike in oil prices due to the start of the Ukraine war, and now we're doing the retest, and we could well drop to retest the trend lines here, which could see us fall back to around potentially $56 over the course of this, perhaps the next 6 months. It's a potential, but there's no guarantees, and so we're in the process of doing this pullback and potentially a retest of the trend line break before moving onwards and upwards. And so although it seems like oil might not be a great place to be invested, this is precisely the time where you want to start building positions, so that by the time the retest comes, you're fully invested to take advantage of what we expect would be another large leg upwards in the gold price, and that would see us probably break through the highs of $130, $150 a barrel, probably hit $180 potentially. So this is the big picture, and it's important to stay aware of the big picture to know that we're in this stage where we seem to be forming a new leg up once we potentially do a retest of this trend line, and that could coincide with there's all sorts of talk of a recession and weaker demand. So let's see. We might not necessarily do a full retest. Sometimes we just do a partial retest, which could see us hover around where we are and then continue upwards from here. So it's important to have some skin in the game, so to speak, if you're worried about the retest not being a complete retest. Anyway, that's oil. Let's take a look at some of the other energy commodities. So natural gas has also been in a parallel descending price channel, which is a period of consolidation over the last 15 years, and we'd expect a breakout to the upside to come in the next few years. Other energy commodities, we could take a look at coal, and I think coal might have potentially had its large leg upwards, and already because we've essentially moved where coal was in the range between $50 and 140, so between $50 and $140 a ton. We've now broken up, and we went all the way up to 420, roughly $420 a ton, which is a significant move, and now we could expect a long period of consolidation at these new price levels between, say, 100 and 400. This could be setting a new level for coal. So less bullish on coal, because the large move in coal has probably already been done, which is definitely not the case for oil. The oil chart looks a lot more promising, but nevertheless, such higher coal prices will mean that coal mining companies will have high cash flows over the next 10 years, which means large dividends, and it could still be a place where one might want to be invested. So that's the energies. So as you can see, uranium, we've not even hit the previous peak that we were in the previous commodities bull market in 2007, and so uranium on a relative basis is very cheap, and I wouldn't be surprised if we go back and retest these levels from the previous peaks of the bull market and perhaps even break through that. But uranium is a market which I would expect considerable upside. So we'll move on to the precious metals, because ultimately, if you view gold as the quintessential form of money, then it makes sense that as gold is repriced based on a devaluing dollar, gold becomes seemingly worth many more dollars, because each dollar is worth less over time. So as this, what is the truest form of money in gold, sets a new price range, we'd expect all commodities that are priced in against gold, which is the real form of money really, to also enjoy significant bull market. So gold has been in a period of consolidation over the same time period, around the last decade or 15 years, and the high has been around the $2,000 level. And you can see that we're coming up and we're knocking on heaven's door, so to speak. We're trying to break through this $2,000 level, and it rarely happens in the first attempt, so it takes some time. We've had consolidation over the last few years as we're trying to break through this level, and on the smaller time frame, importantly, this period of consolidation over the last 2 years or so has seen us break through, and we come back and we're just completing the retest of this trend line as we speak, which means that we expect the next leg of gold to be very imminent, meaning the next 6 months of this year. I made a video about this a few weeks back, where we hit our level, hit this resistance level at around $2,000, and I said we were likely to have the retest, and I think we're just completing the retest as we speak, and I think there's a significant move coming in gold. And so the gold and silver miners as well. Let's take a look at silver. Very similar thing. So we're in a new rising trend coming out of this period of consolidation, and as you see, we've done a retest of this trend line in silver, and the end of the week was very nice. We pulled back and we dipped slightly below the trend line, but we've recovered the ground and we're sitting on the trend line for the end of the week. And yeah, so the precious metals look very positive. Is actually similar situation in platinum also. So sorry, it's a little bit more messy. There's lots of trend lines here, but I hope you can see that there's a similar consolidation period, a price channel where we're between an upper and lower bound, descending bounds, and we broke out. We've come back and we've done the retest of this level. Hopefully this is something which will then push onwards and upwards with gold and silver. So precious metals look very positive. I think we're in the retest phase is now complete. It could take slightly longer. You never know precisely, but our opinion is that the precious metals miners present a fantastic value proposition at the moment. And for those that are interested in specific companies, specific names, you can take a look at our website via the link in the description below, where we offer a small monthly fee. We can give you access to our model portfolio with various precious metals miners as well as other commodity producers. Our portfolio is very much skewed towards the commodities at the moment. So you do take a look if that interests you. We still have a early bird discount for those that want to try for the first month. Is half price. So that's precious metals. Then copper is in a similar situation. If we look at the big picture on copper, we have the last 15 years again has been a period of consolidation between around just under $5 a pound, with lows of around $2, so between $2 and $5 a pound. It's been the consolidation. We broke this this descending trend in 2020. We're kind of similar. The chart looks quite similar to gold in a certain sense to me. We have this rounded formation, which we also have in the precious metals, and we're compressing upwards into this corner between the red lines before potentially breaking out above the $4 level and setting a new price range for copper for the next few decades potentially. So and copper, of course, the fundamentals are very strong for copper because it's a metal which is going to be needed for the electrification, the greenification of the economy, which is a big agenda in terms of every electric car needs much more copper than a conventional combustion engine car. All of these wind turbines, solar panels, the electrification of our energy systems is going to require lots of copper to transport the energy from one place to another. So copper has great fundamentals as well. So we can perhaps take a look at some of the soft commodities. Sugar is also in a long-term kind of rising channel at the moment, and it tends to be highly correlated with the precious metals. So I wouldn't be surprised if we saw sugar up from where it currently is, around 25 pence per pound. I wouldn't be surprised if we test the upper level of this trend line, which would see us around 60 cents per pound, which is the kind of the all-time high, is around 50-60 cents from all the way back in the 70s and 80s. And then we'd probably break out into new territory as gold and silver set new highs. Cotton, also we've been in the high for cotton was also where we had a previous high for gold and silver in 2011. We've been in a period of consolidation, and I wouldn't be surprised if this new rising channel, we have a kind of also rounded bottom formation here, where we eventually break out above 200 pence per pound and set new highs for cotton. So all of the commodity space will really move with gold as gold is repriced as the dollar continues to devalue over time. So I think the thesis for the commodities bull market, what some people call the commodity super cycle, is very much intact. And before finishing, I'd just like to reiterate that with some ratios to offer some value around the commodity space. So if we take a look at what should we look at? Let's look at, so here we have the S&P, which is the S&P 500, the US equity index against oil. So when this chart's going up, it means US equities are becoming more expensive, and then you have a commodities bull market, for example, from 1998 up until 2008. That decade was commodities bull market. Oil outperforms US equities, and I think that's what we're seeing now. So this chart, I think these lines are not very well drawn. Oh no, it is a longer history. So yeah, there's lots of data for this. So you can see this channel that we're in, and yeah, we've seen a high in April 2020 for US equities against oil, and now we're probably going to come back down and retest the lower level of this, which means the next decade is one of a commodities outperformance, oil outperforming US equities. And you can see this diagram I've drawn. It looks like a head and shoulders technical pattern is being formed. So we'll probably roll over, and oil will start to outperform US equities over the next year or so. If we look at, so this is another version of a similar chart. This is oil against the Dow Jones, another US equity index, and again oil outperformed the decade of the early 2000s, and it looks like we're going to see that similar thing again. So oil will continue up to test this upper trend line, more than likely, over the next half a decade at least. If we look at oil priced against gold, this tells us the range in which oil has traded historically against gold. So in the 60s and 70s, oil was around 10%. The barrel of oil was around 10% the price of an ounce of gold. The lower range has been around 3%, a barrel of oil being around 3% of an ounce of gold, and the highs have been around 10 to 12%. So between 3 and 10% has been the price range for a barrel of oil as a percentage of an ounce of gold. And you can see that we've been very low in this ratio over the last few years. We dipped below it for this COVID unusual situation where we had these global lockdowns and oil went negative in price. But now we're probably heading up to retest the upper range, and I wouldn't be surprised if gold reprices to say $2,500 or say $3,000 an ounce. It's entirely reasonable. $3,000 an ounce, then 10% of that would be $300 oil, and so that makes sense if we look at the previous charts that we've already looked at. $300 oil and a $3,000 an ounce gold would be a ratio that would see this chart back up to the highs that we've had in previous bull markets for commodities, so where oil becomes expensive. So we had, you see the cycles in this chart very nicely, rising oil price from the 80s up till 2008, and then falling oil price, and now we're in another rising cycle. So this is the commodity cycle, really. So that's oil looking very cheap, hovering around the low level on a historical basis. That's why I think it's not a bad place to be looking at entering the energy sector at the moment, the way that oil is priced. If we look at natural gas against gold, again sitting very low in the historical ratio. So natural gas looks very cheap against gold. Natural gas also looks very cheap against oil. So you see these ratios can tell you, because there's not much point in looking at the price of these commodities in dollars, because dollars constantly losing its own value. So you're measuring something against something else which is not stable. The dollar is constantly less. So it's only natural that that price chart will be constantly rising, going up. Whereas if you look at commodities against one another, they're much more stable, and they tend to trade within a range. So natural gas, oil look both very cheap, potentially great entry points. Coal, not so much. So coal looks to be relatively expensive compared to the other things. That's why I was saying earlier we're not so bullish on coal. If we look at copper, copper priced in gold, you can see that copper looks it's been getting cheaper and cheaper relative to gold over the last several decades, and I wouldn't be surprised now if we break out and retest the highs of copper priced against gold. So that's looking positive for copper. Iron ore, we don't have so much data, so it's a little bit tricky. Platinum, again, something which looks very cheap in a relative basis. So I think I'll leave it there. The main takeaway is that in the commodity space you have a lot of volatility, and so to remain invested in the commodity space it takes some emotional tolerance. Something we try and help our investors with. For those members that subscribe to our service, we try and provide reason, data analysis throughout this coming commodities cycle, and to help when you might look at your portfolio and see it down, it's helpful to stay cognizant of the bigger picture, to remind yourself that we're in a large commodities bull market, and that the gains, when they come, will be big. So as much as you see your portfolio go down on a bad day, when the gains come, there'll be significant moves to the upside, and they can be quite rapid. So if you imagine silver can be up 8% in a day, you might see some of the silver mining companies up 20-25% in a day. This is entirely possible, and those kind of gains could come very quickly within a small period of time as the commodities reprice, as gold and breaks out to new highs. All of the other commodities, the energy sector, soft commodities, base metals, precious metals, will all be repriced, and it seems to be fairly imminent now. I think over the next 6 months to a year, I think we're going to start to see the turn upwards again in the commodity space. In the meantime, you just have to focus on acquiring positions in the commodity space if you're so inclined, if that's something which you're choosing to do. These lows, these pullbacks in the commodities markets are really just buying opportunities to load up, buy more of the equities that you're interested in, and don't look at the numbers. Just when it goes down, you must see that it's just getting cheaper, and it's just a buying opportunity. So remember the bigger picture, stay focused on that. Don't concern yourself with interim volatility, because within the space of a year to 18 months, there could be significant moves. A lot of the equities could be double the price that they are now. So just some thoughts around the bigger picture for the commodities markets. I hope that's useful for anyone who's in the commodity space, and hopefully we'll bring another update sometime soon. In the meantime, take care, like the video, share the video with anyone who might think might be interested, and subscribe to the channel, and do take a look at our service if that's something that interests you. Okay, take care, bye.